Last time we built your first portfolio and learned to spread your eggs across many baskets. Today we ask the next question: how big should any single egg be? This is called position sizing, and it is one of the least glamorous and most important skills in all of investing. Get it right, and you can be wrong many times and still survive. Get it wrong, and being right will not save you. Here is the idea that professionals live by: never risk too much on any one position. A common guideline is to keep any single bet to only a small slice of your total money, often just a few percent. It sounds almost too cautious, but there is cold mathematics behind it. The point of sizing is simple. No single decision should ever be able to take you out of the game. Let us see why with the most important math in this whole episode: the math of drawdowns. A drawdown is just how far your money has fallen from its peak. Now here is the trap that surprises almost everyone. If you lose 50% of your money, you do not need a 50% gain to get back to even. You need a 100% gain, a full double, just to climb back to where you started. Let me show you the numbers because they are brutal and beautiful. Start with $1,000 and lose half, and you are left with $500. To turn $500 back into $1,000, that $500 must double, a 100% gain. A small loss is easy to recover. A 10% dip needs only an 11% gain. But losses do not scale gently. They accelerate against you, and a deep hole becomes nearly impossible to climb out of. This is the whole reason position sizing matters so much. If your worst single position is only a few percent of your money, then even a total disaster, a company going to zero, is a survivable scratch. But if you put half your money into one bold idea and it collapses, you are now staring at that brutal 100% climb just to break even. Protecting against the deep hole matters far more than chasing the big win. Which brings us to the most counterintuitive truth in trading. Position sizing matters more than being right. You can be correct on most of your trades and still go broke if the few losers are sized too large. And you can be wrong more often than not and still grow your money if your winners are big and your losers are kept small. How much you bet shapes your fate more than how often you are correct. This is also why going all in is the cardinal sin. The person who bets everything on one trade is not investing. They are gambling with extra steps. It does not matter how good the idea looks. Certainty does not exist in markets, and the one time the sure thing fails, the all-in player is wiped out completely. The professional plays many small hands, so they can keep playing tomorrow. Staying in the game is the entire point. There is one more quiet tool here, and it is simply cash. Holding some cash is not a failure to invest. It is a position in itself. Cash is dry powder. It lets you sleep at night, and it lets you buy calmly when everyone else is panicking and prices are on sale. It also keeps any one decision from feeling life or death, which is exactly when the biases of the last episodes pounce. A little cash is the cushion that keeps you rational. Now for the honest caveat, the one this series owes you. Everything we just described, percentages per trade, drawdown math, keeping cash, is the language of active stock pickers. If you're a long-term index investor, most of it quietly dissolves. A broad index fund is already diversified across thousands of companies, so its position sizing is handled for you, and no single company can blow you up. For you, risk management is not a spreadsheet of bets. It is steady, automatic contributions through every market mood. So the index investor's version of all this is beautifully boring. You decide on a fixed amount, you invest it on schedule, and you simply keep buying through the ups and the downs. The drawdown math still applies to the whole market, which is exactly why you do not panic sell at the bottom and lock in that brutal hole. You let time and steady contributions do the heavy lifting that position sizing does for the trader. So whether you pick stocks or buy the whole haystack, the lesson rhymes. Respect the math of losses. Never let one decision end your game. Keep some cash and some humility. And remember that surviving is what lets compounding work. Position sizing, in the end, is just risk management wearing a number. I will see you in the next one, where we settle the great debate of investing all at once versus a little at a time. Until then, keep it simple and never bet more than you can afford to be wrong about.